Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial, your investment, and your retirement future. He is president and founder of McIntire Retirement Services. We are always glad to be joined by Chris McIntire. Chris, thank you very much for being here and for continuing to provide the important information that you do for proactive savers and investors.
Yeah, well, thank you. It's always good to be here, buddy.
It is a pleasure each and every time we get the opportunity to speak with you, Chris. And I know that you have provided so many proactive planners across Northwestern Ohio that resource to get that plan put together, to review and double check their accounts, their positions, their investments, and make sure that they are on the right track toward achieving their goals. And ladies and gentlemen, that is the game plan for retirement planning process. If you would like to take part, if you have any questions, if you'd like to do a portfolio review, double check things, make sure that you are in the best and optimal position to achieve your goals into the future. Pick up the phone, give Chris McIntire a call, 800-868-1194. The number to call, 800-868-1194, 800-868-1194, or you can visit online, McIntireRetirementServices.com, McIntireRetirementServices.com. And as you typically do, Chris, an additional valuable resource for today's program, this report on the 9 critical risks to plan for a secure financial future. Chris, I think that the cumulative total of these basically says, hey, retirement's going to be an exceedingly difficult time. And the gist is that we've got different risks in retirement to face and address in planning than we do during our working career. And we've got to identify those.
Yeah, and I think it's important to highlight that, look, everything involves risk that we do, crossing the street, and even during our working careers, getting hurt on the job and all of that. And then in retirement, like you say, Peter, a lot of different risks probably move to the forefront and other risks move, farther behind us.
So number one on the risk, Chris, diving in and getting right to one that is very different in retirement, that is sequence risk. This is something that a lot of us probably have not heard during our working career because it's not something that impacts us during our working career, but it can be a significant risk for retirement.
Yeah, and I'd say it's an opportunity risk while we're working, because when the market goes down, if we're still putting money in, we're buying at lower prices. When we retire and money's coming out, sequence risk works the opposite. We have less money to pull from when we're pulling money out of the market. And, for those that are just freshly retired here in, say 2020, 2021, 22, and even into 2023, stocks and bonds have both taken a hit here. So, there's a different emotion to it, than when the market's going up, you're pulling money out, watching your account go up. It's another thing when you're pulling money out because you're helping to accelerate those losses. So sequence risk is certainly probably, one of the top 2 risks next to inflation as well, Peter.
Yeah, when the tide is going out, so to speak, Chris, and we are pulling income at the same time, that becomes an exceedingly larger risk. That the withdrawals plus the decrease in the market value sort of multiplies on itself exponentially, the total amount of risk to our future financial years, because we want to be able to pull the income. We've got to be able to pull the income in most cases. But when we do so, as the market declines, that is a specific risk to retirement that really impacts the duration and longevity of our income producing ability.
Yeah, it does. And, an example is keep math easy here. If you had $1 million invested, the market takes a 20% correction, you're down to $800,000. What was generating $40,000 a year out of $1 million is a 4% return. Now you're taking 5% out of $800,000. That's a good description in general of what sequence risk does. It increases your withdrawal rate.
And therefore, we've got to formulate a specific plan to address that potential, that possibility. And there are a number of strategies available to do that, ladies and gentlemen, to specifically address that potential risk and make sure that a down market doesn't impact your ability to pay your bills, not only this year, but for years into the future, plus maintain that comfort and quality of life, the lifestyle confidence. Pick up the phone, have a conversation with Chris, formulate your game plan for retirement, which, by the way, will address all of the 9 risks on our report, the 9 critical risks to plan for in retirement. That game plan for retirement, your valuable resource, and in addition to the program today, the ability to put these concepts into reality into your planning. 800-868-1194. That's 800-868-1194. Next on the list here, Chris, legislative risk. Now, we know taxes are one thing, and we will get to that specifically in a little bit, but the government can change the rules on a lot of things. Social Security, Medicare, 2 of the big ones for retirement.
Yeah, they certainly can. And they're, here recently, some of that has been thrown out there. A good example would be the Secure Act. All right. They raised the rate, the age at which you have to begin required minimum distributions, but they also changed how long those IRAs have to be paid out when they go to like your children or grandchildren. They used to be able to stretch it over their lifetime. So if their life expectancy was 40 years, now they have to take it all out within 10 years, no matter essentially, as long as they're above the age of 18. There's obviously exceptions to that, but that's an example of legislative risk. Okay. And then Peter mentioned taxes, and, and just recently here, the president's talking about raising, income taxes on the highest earning to help shore up Medicare. And, but again, that's, it affects a small part of the population. But again, it is just an example of legislative risk.
Yeah. And Chris, I'm going to jump ahead here to the taxation, which is a specific kind of subset risk of legislative risk. We also know that as things stand today, if nothing's done, taxes will be going up on a much larger swath of the population and of our income. It's not just those $400,000 plus, it's the 12% bracket that will increase to 15, the 22 that will go to 25. Basically, we will be paying more in taxes across the board, and the standard deduction could be impacted and lowered significantly.
Yeah, exactly. And Peter's referring to what is currently the 12% tax bracket, had previously been 15%. That was a pretty big middle income tax cut back when President Trump was in office. And I did the numbers on that, and that was a ballpark about $1,500 in savings there. Okay, well, those laws are going to sunset after being in effect for 10 years. So I want to say it's 2026 that those tax rates, if they're not extended, will increase or sunset back to their previous level. So 12 goes to 15 and 22 goes to 25%.
Yeah, and we need to be aware of this, one, but we need to plan proactively for these risks as well. And that's what the game plan for retirement is all about. Again, if you would like to review and evaluate your current portfolio, make sure that you have specifically addressed these risks in your planning. Pick up the phone, give Chris McIntire a call, 800-868-1194. That's 800-868-1194. If you'd like this report on the 9 critical risks to go over on your own time and consider if you have an appropriate approach to each of these in your planning. Again, you can give a call to McIntire Retirement Services and just request the report, the 9 critical risks to plan for. 800-868-1194, or go online, McIntyreRetirementServices.com, and just click the Connect with Us button. You can make your request there. Chris, you sort of touched on this one as we were talking about sequence risk, but even on a regular basis, we don't want to withdraw too much too early. We don't want to be so tight and frugal that we could have enjoyed life and retirement more. So the withdrawal rate risk, that is really something that is addressed specifically through the income planning process so that we can have durable, dependable income.
Yes, and we've got a nice software program that we utilize for clients, and they can see in real time if they're going to, withdraw a certain percentage of their income, of their investments for income in their retirement. And then maybe they want to do their traveling earlier in retirement, which makes sense because they're probably in better health, is building that level into it, because if you read all the publications, they, the 4% rule is you withdraw 4% of your nest egg and you adjust it for inflation. But what if you want to spend 7% of your nest egg early in retirement to do things you always hope to do, and then spend less down the road? So just to say that, hey, we're going to follow this one concrete rule, I mean, that's not how life is. So you have to have that flexibility and to be able to see, what do those parameters do for you throughout the course of different types of market cycles, high inflation period like we're looking at right now, help to accentuate that withdrawal rate risk tied into that sequence risk off of the behavior of the market. So some of these risks also, are very correlated to other ones that you'll run into in retirement potentially.
Absolutely. And we're giving a very high level kind of description and overview definition of these risks so you can better understand them and maybe apply them to your situation. But that's what the game plan for retirement really helps you do and accomplish, ladies and gentlemen, not just be aware of them and understand what they are, but specifically format your plan, lay it out, put it in writing for how you will address each one of these items. And that is a no cost, no obligation process, and available through McIntire Retirement Services. You can get your game plan for retirement put together, the proprietary planning process there with Chris McIntire. 800-868-1194. That's 800-868-1194. Next on the list of the critical risks to address, one that unfortunately, Chris, the costs take a lot of people by surprise, even for routine healthcare expenses. But those major ones are something that can absolutely be catastrophic to the financial well-being of ourselves and our family if we don't properly plan and prepare and address those.
Hey, buddy, we personally are responsible for somebody that's in a long-term care facility, and it's about $8,000 a month. That's $96,000 a year. Thankfully, they had planned and prepared for something like this, and they have an insurance policy that pays 100% of that bill. Okay, and that's not infinite. Not all of those types of policies last forever. And Peter, you and I got a good friend that is needing some care after having a stroke way before we thought they would, be at risk for one of those, even before the age of 60. And just getting into, the phases of how much it costs for 24/7 care in a home without any type of protection whatsoever. So, you have to plan for the unexpected because life is what happens to plans.
Yeah, absolutely. You got to understand those potential risks, do what you can to take care of yourself, but also to make sure that from a financial standpoint, you are protected. And Chris, kind of like every other insurance that I purchase, I really hope never to have to use it, right? That's kind of the basis of insurance, is that we hope to never have to use it. But man, is it certainly important in the protection that it provides if the event that we're insuring against does happen, right?
Yeah, and Peter, I have this conversation all the time, and when you've been impacted by one of these events, you certainly have a little bit more passion for it. We sell life insurance, and we see the benefits of that. We do long-term care type protection. We see the benefits of that. If you think about what I just said, at $8,000 a month in a nursing home, that's $100,000 a year, $200,000 for 2 years. And a lot of people that are listening to this radio show, their house isn't worth $200,000, and yet they have it insured in case it burns down, which has a 1 in 1,200 chance, I believe. You have a 50% chance of spending at least some time in the nursing home. And who do you want to, if that was to happen, who would you want to pay for it?
Yeah, absolutely. Moving on with the list here, we got to make our way through all 9. Spousal income. Now, Chris, when we are making our decisions on Social Security and pensions very early on in our retirement timeline, sometimes the implications of those decisions don't have their consequences until very late in retirement or even after our own lifetime. And we have to consider the implications on spousal income from those decisions.
Yeah, no question about it. And, here in the state of Ohio, some of that also relates to somebody having like a government pension, a state teacher's pension, for example. And if one of the spouses has Social Security, if they pass away, they may not get any of that of the spousal Social Security because they have a government pension. So, that's another consideration here in the state of Ohio that we also have to take into, under our, in our planning process is all of these elements of, what type of pension survivor benefits is there going to be if someone was to pass away, and, what are the remaining assets? And again, that's where that life insurance hedge can also help take away some of that risk as well, whether or not it's a basic term policy or a little more comprehensive life insurance policy with some long-term care benefits associated with that death benefit as well. To try not to get too specific there, but just in general, some ways to hedge these different types of risk. That's what we're talking about on the show today.
Yeah, but if you don't know what your plan for that is, if you could not describe it in detail, how the impacts of income will last beyond your own lifetime to protect your spouse and family, then you need to get that plan in writing. At least be aware of it, understand the implications of the different sources and streams. It is a critical risk to plan for in retirement. And again, if you'd like this list of all 9, or if you'd like to specifically individually review your plan to see how you are approaching and addressing each of these 9 critical risks, pick up the phone, give Chris McIntire a call at McIntire Retirement Services, your resource, 800-868-1194, 800-868-1194, or you can go online, McIntyreRetirementServices.com, and just click that Connect with Us button, and you can request the list or the time for that no cost, no obligation game plan for retirement. Get your plan put together. Chris, next on the list, one that we've all seen after a year like 2022 and really here into 2023 as well, market volatility is a big risk that we need to be aware of and specifically plan for, because it is going to happen.
Absolutely. You can see the gray hairs. It's not been an exciting couple of years here in 2023. The volatility is certainly continuing. It's it's kind of like, all right, the recession that has never come yet. Everybody keeps talking about, well, they're raising interest rates. Are we going to have a hard landing into a recession as the Federal Reserve tries to cool this economy down to keep inflation in check? And, apparently it looks like they're going to go, and take extraordinarily, harsh measures to make that happen, regardless of what's going on to stock prices. The Federal Reserve doesn't care about stock prices. They care about employment and also, the inflation rate. That is their main objective, full employment and inflation in that 2% range. And, that throws the bond market into upheaval and also throws the stock market into upheaval. And here's one of the reasons why, Peter, is, you can look in the paper right now. We buy CDs, certificates of deposit, for our clients in their brokerage accounts now at 5%. So if you can get 5%, risk-free, why are we taking risk in the stock market? So that's also leading to pulling money out of stocks and going into other asset classes, which obviously affects the prices of stocks. It's the law of supply and demand. So we got a couple of, how do I want to say it? There's a couple of points that need to be made when we just talk about market volatility, because it can be bond market, it can be real estate market, it can be the stock market, like Peter says.
But bottom line, Chris, all of them have the potential and the likelihood to see volatility perhaps many times over the course of our retirement. And if our plan does not reflect that, if we are basing our outlook on kind of this linear 5, 6, 7, 8% rate of return without the potential for some down years, some negative 20, negative 25, 2025, years that come along, some shocking years in the bond market and in the real estate market, then we probably don't have the plan that truly addresses these 9 critical risks that can throw our lifestyle off course.
Yeah, you're correct. If you go back and look at the 1970s, for example, when we had, a period of very high inflation, that was a very bad time for the stock market. Okay? It was very good for savers because you could go into and get a 10, 12, 15% certificate of deposit as well. So, depending on your debt ratio there, but as you do go through an investment life cycle, that's for the long haul. That's why you have to ride out the ups and downs of the stock and bond markets. It's not about trying to time it. It's the amount of time you spend in it, and then adjusting your portfolio as you get a little bit older. Like right now, it's easier for us to help ladder in some certificates of deposit in clients' accounts because they're making 5% risk-free. And for a lot of them, they want to pay that interest out to themselves. So boy, that just makes our job a little bit easier in some of those respects.
Chris, you mentioned that, and you mentioned the attractive interest rates that are now available in things like CDs. With the traditional buy and hold approach, I know a lot of people kind of just rode the good times from COVID all the way through the end of through 2020 through 2021, fantastic period in the market, but essentially just kept the same approach, the same positions through 2022, and therefore rode that roller coaster all the way back down and kind of are right back where we started before those good years. Does that give credence to the fact that we should not be so buy and hold and so hands off that we are not making those kind of proactive adjustments when opportunities for attractive risk-free rates of return are now available?
Yeah, and as you get older, you're certainly are going to want to have a little bit more of a tactical approach instead of just set it and forget it, if you will. And, and that's what we do for our clients, through our regular meetings and gauge where they're at emotionally, how they feel about things, but we also do a lot of safe money with them anyway, so, if we have a safe money strategy and maybe we can turn an income on using the safe strategy for them, whether that's CDs, multi-year guarantee annuities, longer term index annuities with income elements, that don't have that stock and bond market volatility, that have, a real, a foundation of protection, it takes away some of the emotional elements on the investment side. So sometimes we can ride through some of these storms and take advantage of sudden turns in the market as well. So, everybody's got a little bit different approach. So I just wanted to say, we do different things for different clients is kind of my point there, Peter.
Access to all of the available options out there and weighing the pros, the cons, the features, the benefits, the disadvantages for figuring out what is the most appropriate to help you achieve your goals, and then not just set it and forget it, ladies and gentlemen. Actually tactically paying attention, being proactive, rebalancing strategically, and for a time optimized horizon there. That is what Chris McIntire does on a regular day-to-day basis there at McIntire Retirement Services, helps to formulate and implement the plans and then monitor them along the way to stay on track with your goals. So again, if you'd like to get that no cost, no obligation plan review strategy session, get the plan in your hands. It's the game plan for retirement. Pick up the phone and give a call now. 800-868-1194. That's 800-868-1194. We spoke on it, Chris, but it bears repeating because you are a self-proclaimed tax geek. We are going to need to address taxation in retirement. In fact, it's something that a lot of people have set themselves up to be very inefficient with. And sometimes we forget about that tax bill that is going to be owed when we retire.
Oh, yeah. Somebody's going to pay the freight at some point. And, for most people listening to the show here today, they've been saving massive amounts of dollars in their 401ks because they probably don't have a pension plan anymore. And, when they pull those dollars out, they're going to have to pay income tax on those dollars. if you've been fortunate enough to save money outside of outside of an IRA account, and we may be able to spin off dividends and capital gains taxes and utilize that side of things in a tax planning strategy. But the bulk of people listening today, have done everything in 401ks and IRAs, and maybe they don't even have a Roth IRA. So how do we efficiently exit dollars from those IRA plans in the most tax efficient manner and not do it just in one fell swoop because somebody, read something on the internet that says, hey, Congress is going to come and take my IRA. We have to talk people down off the cliff, if you will, keep them from going out on the skinny branches, another cliche, but try to help educate them on, here are the impacts of, pulling $150,000 a year out. Your Medicare premiums are going to go up. So there are some other pitfalls or loopholes that they can fall into, Peter, and we want to help them navigate those.
Well, Chris, I've heard that fear as well, that discussion of, the government's going to come and confiscate my money, some austerity measure like the island nation of Cyprus had like a decade ago, where they just came and sort of took over accounts and took some money out of their citizens' bank account. Bottom line, we don't need to have that happen in this country, and therefore probably won't. All that needs to happen is that they incrementally raise the tax rates and brackets, which is already on the books, and they essentially accomplish the same thing without that kind of shock value of wealth confiscation, right? So it's something that we need to plan for. It's something that we can control, but many don't. Many sort of ignore this and default to the IRS's plan, rarely ever in your best interest, by the way.
Yeah, and I probably have a lot of clients that are listening today and would say, why didn't the government just spend less money?
Yeah.
Yep. And you're right, Peter, though, like right now you're hearing talk about maybe some tax increases and whatnot, and they're implementing them or trying to sell that using class warfare, because that's what politicians do on one side of the aisle, probably more so than the other. But anyway,
something that affects us all, Chris, inflation, yes. Right? 2022 really a lot into 2021 and still here in 2023. It wasn't just a one-year event. We have been experiencing inflation in our plans, a critical risk that we must address.
Yeah, absolutely. If inflation is going up by 6% a year in 12 years, you'll need to make twice as much money or have twice as much income to do the same things you're doing today at 6% inflation. That's why it's critical that they get it down to that 2% level, because you can adjust your portfolio and your income needs and, a lot easier at 2% than you can at 6% a year. That's not good. And what we're running into right now, probably, Peter, is the wage growth, right? That's why they're trying to, I don't want to say crush the economy, but do economic damage so that wage growth will slow down, because that's where you're getting a lot of the inflation.
Well, it's a matter of, which is the lesser of two evils. Either is going to create pain, but inflation affects everybody, where if they try to control inflation and do a little damage to the markets, right, that only creates pain with investors. So I understand the thinking. It is a painful process to go through. They understand that as well. Chris, the last one on the list of the critical risks to plan for is one that multiplies the potential for all of these other risks. It's actually something we hope for, but at the same time, it makes financial planning more difficult: longevity. And you actually formulate plans specifically to turn that longevity back from a risk to something that we hope for.
Yeah, absolutely. And, my father-in-law is 94 years old. My dad is 89. So, we have some longevity in our family. And I'll use my father-in-law as an example. He's been getting the same pension payment from the company he retired from up in the Toledo area since he was 49 years old. He is 94 now and still getting the same dollar amount. Okay. That's inflation risk right there. And how do you hedge against that so that your income can increase with the rate of inflation. And thankfully, in the year 2023, there are a lot more tools and instruments that we have available to help combat that than what we had back when my father-in-law was 49 years old, which was long before I was born, of course.
Well, again, ladies and gentlemen, the report, The 9 Critical Risks to Plan For in Retirement, is available to you. Or if you would like to sit down and review and evaluate your specific plan to make sure that you've addressed all of these 9 critical risks, pick up the phone, give McIntire Retirement Services a call, 800-868-1194. No cost, no obligation. Just pick up the phone, give a call, request the list or the time for the complimentary review, the planning strategy session to get your game plan for retirement. 800-868-1194, 800-868-1194, or you can visit online, McIntireRetirementServices.com, McIntireRetirementServices.com. And Chris, it is always a pleasure. You always bring up insightful, important topics of conversation for those proactive planners out there looking to make goals reality into the future. Thank you.
Yeah, my pleasure. And I hope everybody's looking forward to spring here. We're just about there.
Just about there. Absolutely. Always a pleasure, Chris. See you next time.
Thank you.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.